Hi, everyone. Good turnaround Tuesday. Okay, Gaurav. Hello, Ryan. How are you?
Yeah, morning, Dale. You good?
Good. First day of winter. Happy solstice day, everyone, as well.
Does it start getting lighter from tomorrow?
Yeah.
2 minutes a day.
Yeah, and it's a season. So I hope everyone has a great winter trading season. And I think one of the ways to accomplish it, if you haven't already, is take the trial and get ready for memberships on sale in a few weeks. Gaurav, hi, Sinatra, Hugo, Jason Wright, how are you? Majid. Okay, so I just want to start off with this. This is what you want to see if you're a precious metal bull, is that this gold-silver ratio has peaked out. So I'll tell you what I'm looking for. I know a lot of people, and it's possible, silver to silver bottom on the Fed, and this is the bottom or a bottom. So I don't know. My preference is, maybe we rally back to here and we get one more flush. Okay. So if that happens, we get one more flush in silver and we see the $20 handle in that range. What you're going to want to see is that we have some type of failing rally in the gold silver ratio. Okay. That'd be a confirmation, or at least a market tell that silver is outperforming, even if both gold, rallies back to, I think Greg was talking 1830-ish or so, and then he showed, I think it was a triangle. You could go back and watch it on the video. He was here Friday. That gold, may rally up to here and then have one more break. So the key is going to be what happens to this gold-silver ratio on that for, determining a bottom. Okay, and I'd say that would be a failing rally in the gold-silver ratio. Dollar couldn't get through the highs again. Maybe we get, finish this off, have one quick correction to 95.5 or so. And then next year we make our push towards 98. And, we had a recovery in the S&Ps was yesterday. It could have been, and that we're starting to head up, and we get the Santa Claus rally next week, right, Ryan? And It happens after Christmas, and then we have the January effect, and there should be a lot of new money coming in. I've read that puts are extreme. They've been extreme. I was in some. I don't think they're paying big because you're paying a lot for them, but we'll see if that was it in the S&Ps. And I think that's about it. What's going to be very important for me is what Aussie does if the dollar breaks 100 pips from here. So, maybe we still can accomplish this move up here. And maybe I'm all wet and the dollar is just topping here and that's it. So, I imagine all these scenarios in my imagination so that when I see them on my screen, I already know how to react and what I'm going to do. So that's what I have. Hope everyone has a great trading season. So just like we have seasons in everything, in fashion and what kind of clothes we wear, we have seasons in the market. And let's have a great winter despite all the chaos going on around us and all the news, Omicron, and stay focused on opportunities because a lot of people got rich focusing on opportunities after the first COVID crash. Some people just had too much fear to take advantage of them. So, just be prepped, right? That's the key word. Maybe I will not trade. I will not take a trade unless I prepared for it in 2022. In fact, why don't you write that down? Go ahead,
put
bro.
a post up. I actually put a post up about, you know, the merits of trying to trade in this, you know, this time frame, this week.
Yeah. Yeah.
Because, you know, it's a busy year for families and friends. And, you know, we had I don't know about you, Dale, but it was a crap Christmas last year for the family. We were all locked down and couldn't see anyone. And, you know, we're some people are facing that again this year, you know, so switch the screens off, go and spend time with your family. You know, market's going to be here in January. We're all going to come back.
Yeah.
You know, nothing.
You know what I say,
nothing
Ryan?
to disappear.
When it's all said, I say when it's all said and done, you're not going to remember your greatest trade or your best quarter. You're going to be thinking about the people you laughed and cried with. So, you know, don't get carried away with the market so that you're not appreciating what is here today and could be gone tomorrow. So that's,
and if you are going to trade, then you're right. You've got to pick your battles, not get too deep into something, don't get caught in the middle of something. I mean, one thing, you know, you can analyze still. I mean, what I tend to do this time of year is I look at what happened last week, because last week was a busy week. Last week we had all the central banks. You know, the market moved where it wanted to go. This week can be a bit funny and next week can be a bit funny. So it's not necessarily a true indicator of what the market wants to do. So I always take last week and how that week finished is how potentially the new year starts, because that's where the last of the big money went moving, the big expectations changed. That can be how we kick off the new year. You know, so in the case of what we saw last week, we saw dollar strength, right, faded a bit, but we saw, you know, we saw the euro dip, we saw cable dip, Aussie dip, you know, that can be a signal for what comes in the new year. So you prep yourself, you know, you get ready. I'm not keen on doing anything unless there's a standout headline or move to trade, something that's, you know, way out of kilter for the moves.
You know, if you just take this range here in the dollar, 96.90, call it 100, gives you 90, almost 98, 97.90. It's a big rectangle.
Yeah.
So, you know, I've been waiting for that number before I saw a rectangle form. So now a rectangle's forming, and coincidentally, you know, I say coincidentally, it's not coincidence. It's, you know, market is geometry, but, you know, you could come to the same endpoint using different geometric formations. And this says 97.90 when we break out. So, that kind of gives me a little more conviction about that 98 number. So just something I talked about.
But you know, you can take a look at cable. You know, you look at the weekly, and we got those moving averages and all that support. You know, from sort of 31.50, you know, 31.80. You've got the weekly moving averages. You've got the monthly moving averages in there. You know, on a closing basis, on a going forward basis, you know, this is turning out to be a pretty solid support area. You know, and if we finish the year above there, that's potentially going to set the tone going into 2022. You know, can we break this area? If we can't break this area, we're going to head back up. But if
35 looks 35 looks viable.
Yeah, but if we break this, let's call it 31.40.50. You know, we could be heading much lower. We could be, you know, on our way to 125. You know, that's as big as it could go, because it's going to take something to bust this area. So, you know, I'm potentially looking to play some sell stops through that area, 130, 150, 40, perhaps, you know, catch a break if it does go.
Yeah, and EG's stalling up here, so that would favor cable over euro if we're going to head down again. What do you think? Was this it? And we're heading back to new lows or a breakout next year? Yeah, you know, it's a coin flip, right?
Yeah, I think, you know, it's. I still favour the Bank of England over the ECB. I mean, they've already you know, hiked, and they're likely to hike again before the ECB. So, but what I want to see this one move. I want to see this one lower on those expectations, because everyone's expecting the Bank of England to hike more. ECB has still got their head in the sand or up their arses, depends how you view it.
Well, we have the super dove Danny Blanchflower joining us today.
Yeah, that'd be good. That'd be
I
good.
brought him in. I think I know what his answer will be about the BOE rate, raising rates.
You could do his interview in advance, couldn't you?
Yeah,
but if we
go
don't see this break lower on the central bank divergence, then I'm going to be thinking to myself, okay, we're all priced here, and then that's when I'm potentially going to look to exit my long held shorts and maybe switch into euros. That's shaping up to be my potential trade of next year, getting long euro.
Yeah, I think so too. I think, I just a guess, 1430 and then one more low. Because I wasn't impressed with RSI readings at the low, but you see, with it doing nothing here, Ryan, that the RSI has, is not oversold anymore. And if we had one more flush to 10.5, there's no way we would confirm this all if that happened, especially if we go up here first. But I think that's, I think that's a trade of the year in 2022 at the short side of the dollar. Milkshake theory be damned. That's my bias going into it.
Let's stick it on the toilet wall and see where we are halfway through the year. Yeah.
Where we could see 130 euro again.
Yeah, and the same euro sterling, that could get back up into the 90s, 95s, that sort of area. If the ECB are forced to to turn tail and hike sooner than expected. And the RBA are another one. They're still pumping 2024 rate hikes. I think they're bonkers, as I've been saying for a long while. And that's another trade I'm going to be looking at. I'm already long in very small bits. A bit of a build from 75 down to 70. And we'll see how we go.
Yeah, I don't like this RSI, Ryan. But anyway, we could rally up to, I was thinking 2.5, and then get one more low. But I'm just preparing myself to. In fact, Steve told me about this place called Revolut, where you could just hold your cash and convert it to any currency you want. So I'm doing that. Yeah. Instead of having, US dollars in my.
We're buying lira, Turkish lira.
Yeah, and not lira. So, you love Revolut? Okay. You feel safe having a lot of money there, Jace? Steve Volge does. Oh, not much? Okay. All right. Well, so, think that maybe we can do this one more time in here, and maybe end up with some type of flag, one more low. And, I know that there's some markings. I don't put these triggers in. So, Blake must have some measured move down here. I would back up the wheelbarrow there for Aussies.
Yeah, I think we could potentially get a flush. It depends where we are going into the new year. If we're sub 71, I can see us maybe hitting down to 69, 68 on a bit of early optimism, bit of dollar buying, and I'm going to have to assess whether I want to keep buying it or shorten the position a bit. Okay. Well, maybe Blake's around.
I'm here. I'm here too. Good morning.
Oh, hey I thought I read your Skype. So I didn't think you'd be around, but
no, I'm here.
Glad everyone's okay, Stel. So, you saw this gold silver ratio, right? So,
I saw that, and yes, I've been saying for a while that I want to get long a lot more silver, but I am waiting for this ratio to drop below 73, which is the big support. I know we're not there yet. We're not there yet, but
that was near the low. Oh, I see what you're looking at.
Yeah, that will mean that the silver is that the metals are rallying already, and I don't mind adding when they do break there. Now, I will add if we do get in. I've said it before. If we get in the low 19s, 19.5 in silver, I know we're a million miles away, but we've seen stranger things happen. So one of the two. If we get in the low 19s, I'm going to add. Get some long silver. If we see this ratio break below 73, I'm getting long wherever silver is. So simple strategy for me.
You
and
know what
that's,
what I'd like to see
Yep.
is if silver does break, and I don't know about 19, that's a great area, but just see it makes any kind of new low, and the gold silver ratio puts in a failing rally, that would be a message too. Silver making a new
I
low
agree.
without the gold silver ratio making a new high. That's something we'll be looking for should that occur next year.
That would be a very, very good signal, I think. I think you're spot on.
How you doing, Blake? Oh, go ahead, Stel.
No. I was just going to add one more thing. I agree with Ryan regarding the euro. I want to be buying the euro dollar. So sure, I want to short the dollar against the euro. Not doing it yet, but I think with my time horizon, which is not 1 day or a week or a month,
Right.
I want to start getting long. Not yet, but this policy divergence between the Fed and the ECB is pretty huge at the moment, and I think that it will eventually narrow. Is it going to be the Fed that's not going to underdeliver, or is the ECB going to get more hawkish or less dovish? I don't know, but I think that this is the trade to have in currencies for the next year or two. That's my.
Is to have what? Wait, hold on. I'm sorry.
ahead.
I was just in the middle of reading something. What'd you say, Stel?
Long euro dollar. Not here, right now, but I think with a horizon of like a year or two, I think that's going to be the trade to have.
Yeah, Blake, your
God, I just
prophecy is
puked
going to
in my
come
mouth.
true. Yeah,
You
your
what?
prophecy.
I just puked inside my mouth.
Why?
Buying euros?
Well,
Yeah.
we'll buy me, Stel, and Dale will buy what you're selling, Blake.
Well, you know what? I mean, I'm just joking about that. But you really think the euro is going to be the place to be, right?
Yeah.
I'm not saying it's
year.
going to be. I don't think it's going to be the currency that's going to outperform all other currencies, but I think it's this pair is going to be heavily skewed now. The risk reward to be long.
Yeah, you know what? I'm with you. I just don't know if this is it. This is the place.
I'm not saying it's
not now.
today. Not today. No.
Yeah, I'm
How about
about 2
110.50, Blake? Do you have anything there?
What's that?
You have anything at like 110.50
I'm
in
not
the euro?
Not
fibs or
really,
anything?
but I mean, I'm looking. 110 is like the 70. Here, I'll pull up the charts here, so you guys can see. I'm really not. Just so you guys know, and I'm gonna tell you guys what I did this morning. I actually just closed out all my positions this morning, everything.
Wow.
And this is. I'm just telling you guys because I was long the euro. I've been long the euro for gosh, it was about like 2 weeks. But this is that consolidation that we're seeing. The scariest thing about this is that we had the sell off in the euro. I was expecting a big bounce here, big 618 retracement, from the COVID move, multi-year trend line, we're testing it, but we're not even bouncing. I mean, I've been sitting here long the euro forever. And then, I bought the Aussie down at 70 cents. I just sold that after having it forever. And I even took off all my additions, and and the Aussie treated me really, really well this month. I mean, it's been awesome. Like made my entire December, but I'm a little bummed out that we're just not getting a lot of US dollar weakness here. I would have thought that we've seen a bigger move up in the euro, but I booked everything just because it's the end of year. We're coming into the holidays. It's like, okay, do I really need the exposure here? It's more, when you're looking at the euro in this range, which we've been talking about for like the last 2 weeks, and we're in the middle of the range, how much of an edge do you have at these levels? Right. I don't think there is any, right? So now going back to what you were saying, Dale and Ryan and Stel, maybe the euro gets a little further, towards 110.50, maybe 110, maybe 111. Maybe we see one more push in the euro lower. I ultimately I would like to be long. I just don't know if I really want to be long at these levels anymore. You know, I expected a much bigger bounce, but you guys tell me why are you so convinced that the dollar is going to hell in a handbasket?
No, it's
Somebody
not,
explain
it's not
it
a
to
question.
me.
It's not a question of the dollar going to hell. It's
So this is is Euro going to acquire a couple more countries in the EU? I mean, what's happening?
yeah. The UK's going back in.
Okay, but why is the euro? Why would you expect
For me,
the dollar to weaken or what?
For me, it's purely on the central bank divergence. You know, here we are. We've just come through a Fed who's accelerated the taper, who's pimped more hikes to come over a shorter distance. You know, we're looking at 6 hikes over the next 2 years, which is much more than what they were looking at before. And the dollar hasn't rallied. You know, yields haven't gone up. Now, this could be a bit of a holiday effect, and we're going to see that kicking in. But at some point, we're going to be fully priced on what the Fed's going to do. The central bank trade is over for that. Same with the Bank of England. They're entering a potential hike cycle. I think once we get a bit more confirmation of that, that's when my euro sterling's done. I don't trade what the central banks do. I trade what the expectations do, because that's what moves the market. So once the Fed's done, once the Bank of England's done, who have you got left in the pile? Who isn't tightening? The ECB and to a lesser extent the RBA. So what's that going to do for markets? No one thinks that the ECB is going to raise rates until God knows when. But if they're caught out, like the Fed have been caught out, and like the Bank of England been caught out, and like every other central bank's been caught out, because they've been behind the curve on inflation and all this issue, they're going to be forced to do it. And what's that going to do with the euro? It's not going to send it lower.
Okay, I hear what you're saying. I'm still in the camp that the dollar index has further to go. Now, I hear what you're saying as far as the central bank divergences. But I don't think the Fed's anywhere near being done yet. And I think the Fed
so you think they're gonna hike more than 3 times next year?
I think they're gonna hike more. I think they're gonna hike sooner than the market expects.
Wow. Okay.
Before March?
Huh?
I
think the market's gonna start looking at even a faster
Taper.
No, I don't think. I think the taper is going to be fine. I think there's going to be more rate hikes being priced into 2023 than currently is. So we might be on pace this year, but people will start looking ahead into 2023 and see those dots move. But I do think that the dollar upside is fairly limited. I don't see it's much more than 100 if we even get there. I would just look at this technically. I still believe that the dollar can fall, and it's going to give us an opportunity to be on the long side going into early next year. But I think early next year in 2021 or 2022, excuse me, somewhere like in the first or second quarter, I think we're going to want to be short the dollar. But I don't know. The dollar just, to me, it may not be rallying right now, but we just got finished with a 7-8 month rally in the market's face. I think we're just consolidating those gains, but I don't know. I still think that the ECB is going to have a very, very difficult time moving rates or even adjusting expectations. I mean, how do you convince? Go ahead.
Sorry to interrupt. What I like doing always is, what's the market think about the ECB? What's its pricing? Pretty much nothing. That's what I love it when something is completely out of the question. The ECB being hawkish, out of the question. I love that. And the Fed, yes, of course, they could be a little bit more hawkish and they could tighten earlier. But with what they've announced, or not announced, but what they're telling us, I think the risk is really skewed now. Oh, I think there's probably one more flush. I mean, that's why I'm still not buying silver. I'm still not buying the euro dollar. I think there probably is going to be one more flush. Dollar strength, metals weakening. We've seen the film before. And that's where I'm going to get in. But I think with a horizon of 1-2 years forward, I think this is a trade I want to have on. Not many people trade like I do. I'm not saying do what I say, do what I do, but this is what I'm looking to do.
So let me ask you a question, Blake. If you don't think the euro dollar is going to go higher, would you sell it based on the ECB right now?
No, I just don't have a lot of conviction in the euro at these levels. I'd rather be
But
long.
Aussie you do. Aussie you do, right?
Yeah, but forget these levels for a moment. You know, none of us here are sitting here. We're going to pile in at currently at market, but you know, you're looking at the next 3-4 months ahead. What side are you going to want to be on? Are you going to be short the euro because you don't think the ECB are going to raise? Because everyone expects them not to. So you know, what value is it in being short? Because they're not going to go dovish. But if you don't feel like buying it, especially against the dollar, you know, that's the pleasures of FX trading. We've got plenty of other crosses you can spread your euro exposure or your bias exposure to.
So you're asking more like gun to my head, but you know, the thing is, I don't know if I really want any euro exposure at this point. You know, it's
yeah, fair enough.
Yeah, was that
fair enough? Yeah, you know.
Yeah. I mean, you know, it's funny, you know, when you ask me that question, because so many traders, they ask, like, let's say, you know, let's talk about the euro. People will say, oh, you know, hey Blake, are you still long the euro? And I'm like, no. Okay, so that means you want to get short. No, that doesn't. But people think it's really like on off, like a light switch, you know, like, oh, I'm only buying euro and the light's on, and then I turn the light off and I'm only going to go short the euro now, and I need to be short, and I need to always be in a trade. I'm either going to be long or short. There's no such thing as a cash position. It's funny because that's how a lot of people really think about the markets. Like, oh, you're not bullish, you must be bearish. Yeah. Well, no, not necessarily. I just don't think I have zero conviction at these levels. And you know, I think at this point, because we've had such a big move down in the euro and such a big move higher in the dollar over the course of the last several months, it's like there isn't much of an edge here. Now, Dale, you mentioned the Aussie. I do think that the Aussie is a buy. And I was listening to you guys earlier when you said, hey, I think there might be one more washout. Look, I'd love to buy the Aussie again, down at 70 cents, maybe even 69 cents. Let it sell off a little bit. I think inflation is going to be an issue moving forward. I think it is going to be persistently high. And I think the Aussies, the dynamics of how we trade these commodity currencies might be a little different moving forward. I can see a world where, you know, a lot of people have always viewed the commodity currencies as being more of a growth type of, you know, you want to buy the currency, you know, in a risk on, risk off environment. You know, we might be in a situation where people are buying Aussies because, you know, we have slower growth and higher inflation, and maybe deflationary pressures that we feel globally will still favor owning some of these commodity currencies. You know, I'm not sure about that, but I'm kind of leaning that way moving into next year, which will be much different than the market has traded these types of currencies. But anyway, open to your thoughts there. Crickets.
Yes.
And that would
we're all buying euros while you were talking, Blake.
I know. Apparently so. Well, I'm glad I sold mine this morning. I did, like I said, I actually exited my euro. I was long the Aussie from, you know, 70 cents. We're holding some support, but again, we're at places where I just don't feel like there's a huge edge in being in the markets here, especially just a couple of days ahead of the holidays. You know, I was thinking about this yesterday, guys, and I want to thank you all for being, you know, listening into the F.A.C.E webinar, listening into our, you know, the interviews that Dale does every day, you know, the free webinars. And I want to thank you all for just being here and supporting us. I do want to say that we do have data coming out on Thursday. I was actually not wanting to do the F.A.C.E webinar on Thursday, but we have a boatload of data coming out on Thursday, that on the 23rd, which stinks. We got this PCE, durable goods, Canadian GDP data. So I think we're going to have to be here for that, on Thursday. So sorry, guys.
Okay.
That's okay.
Yeah.
But then I think we'll probably just
We have some Canadian data, by the way, just coming out now.
Oh, thanks.
Retail sales.
Retail sales. Okay. By the way, this dollar Canadian's been very, very strong.
No.
I'm sorry, I didn't even pull up the data flash because I wasn't even paying attention to this data. Hold on, really quick. This is in your ForexAnalytix subscription.
Nice navigation.
Let's see here. Let me move this out.
I don't see the number yet.
No, I hadn't seen the number yet either.
No, I got Philly Fed services out, which is
Current accounts out. Yeah,
the chunk.
I haven't seen the retail sales data anywhere actually.
No.
Looking around. There it is. 1.6%, 1.3%. So, the market was looking at actually the core retail sales came in better than expected. Expectations were at like 1%. So, this comes in a little bit better, and but it's not moving the Canadian at all. So, all right.
Let's bring in Danny. I always look forward to hear from him.
Yeah, so I'm gonna let you guys take over. Dale, I have a great interview with Mr. Blanchflower, and you guys and gals will make sure we catch you tomorrow. Thanks everybody for all your support, and remember, we're going to be broadcasting on Thursday, and then we're going to be done for the holidays. So, Dale, have a great interview.
Okay.
Thanks, Ryan.
Yeah,
thanks, Stel.
Thanks, everybody.
Guys.
Yeah, thank you, team. Danny, welcome back to F.A.C.E.
Can you hear me?
Got your voice, Danny.
Good.
You want to, should we use the cameras and scare everybody?
You can.
Okay.
Oh, I'm able to start video.
Yeah, just start. Yeah.
You've stopped
start
it.
video.
I'm here.
All right.
It's this. I'll try again. Hold on.
It's okay.
You have to allow me. Well, okay, we can do anyway.
All right. Okay. Well, I'm going to share. Do you have anything you want to show today, Danny, or we just?
No, I'm just going to talk to you because.
Okay, cool. Then I'm going to come off camera.
All right.
And we'll, I'll just share the screen and show a few things that are happening. And we may as well start with what was your reaction to the BOE raising rates?
I think, I literally wrote, this is the dumbest decision I think I've ever seen. I actually wrote that communications of the Bank of England is completely disastrous. And in fact, I think Bailey is in deep trouble. I mean, so what you do is you communicate that you're going to raise rates at the prior meeting and you don't.
Right. Yeah.
And then you allow the market and you completely confuse the markets. Then you come to the next decision where the markets are now convinced you're not going to raise rates, and you do for absolutely no reason whatsoever. It's completely shot credibility with the exploding Omicron virus, with the government talking about shutting down. Data on retail sales today, people are not going to the shops. Open Table is, collapsing in the UK. The riding of the London Underground was down 20% in the week before they made the decision. So I think this is probably the worst decision I think I've ever seen. I mean, if you think at the very least, their communications are completely shot. Why would you do this? Why would you simply not wait and watch and look and see what happens to Omicron? I mean, they're talking today about a further shutdown coming. Why would you do such a thing? And in fact, to confuse the market, if you're going to do it, at the very least, do it when the markets were expecting it. I mean, one of the big things that I always
think that the Fed's double taper gave them, a little bit of cover to go ahead and do it?
Well, possibly so, but that wasn't exactly a surprise, Dale. I mean, I think what perhaps we should focus on is, as a central banker, you'd normally, the big thing that I always used to think about was, is this a surprise? So the question sometimes, I mean, the issue used to be with us, would we release a statement? And normally we'd release a statement if we made a change, or we'd release it if it was a surprise. So the question here is why the surprise? You're possibly right that they thought, oh, well, the Fed's done a double take, but
Yeah.
the Fed is still doing QE. They actually haven't finished
Yeah.
doing QE. And the question I guess we should ask ourselves, if they did a surprise, the conclusion must be, well, it ought to be, and I'm sure it isn't, it ought to be that they know something that we don't know. What's the possibility that that's true? And the answer is almost zero. What's the chance that they know something about Omicron or the state of the banks or something that means they have to raise rates? I just think it's an enormous error. And
So that's a new. So basically, we have Omicron, and we have a tightening virus
Right.
that is filtering through to every central bank in the world right now.
Right.
What is their motivation? And I remember when we first started talking, you said Powell, has it right. Yellen, he's with Yellen. Janet has been pretty quiet about the double taper and possibly higher yields. And has this changed your opinion of Powell?
Well, I think the thing that really gets me more than anything is that you hear particularly bank presidents and many commentators behaving as if they know what's coming, as if they have an adequate forecasting model, which they don't, which they have some historical data they can put into that model, which they don't. And the right thing to do is to look and wait and watch and see. So if you're engaged in a taper, well, that's fine. We can taper things down, see how things are going. The labor market appears to be recovering. There's obviously an issue of inflation. But the question is, well, what's coming down the road? And the answer is, I don't know. I mean, I just saw this morning that Quebec has actually said this morning that essentially that's going to close down. You just had the retail sales numbers this morning. But Quebec is closing down. How do they know what's coming? How do they have the faintest idea what's coming? So I hear bank presidents all the time saying, well, we should be in a position where we raise rates in June or September. How do they know? The best thing to say is, we don't know. We don't know anything. This is looking at the website, all the stuff that I've been doing about. Yeah, it's a lot to do with the well-being of nations. I've been thinking a lot about Adam Smith and about what's the purpose, in a sense, of economics. And the purpose of economics is to raise the well-being of nations. And it's not to go in and make stupid pronouncements. The right thing to do is to sit and wait and watch, see how this virus develops. And if it develops in a way that's bad, then you'll hunker back. And if the thing goes away, then it's time to raise rates. But I think the biggest issue now is anybody who has the faintest clue and says, we've moved our forecast back from September to August. Based on what? So I think what we're observing is guessonomics. I think.
Well, inflation has become a political issue.
Absolutely right.
Okay, so don't you think there was a chance that there was a question of whether or not Powell would be renominated or it would be Brainerd?
Yes, I think so.
So don't you think that it's possible that President Biden and Powell told him, he gave him the green light to be an inflation fighter because that's what the people want? Because
I mean, I think the chance that Brainerd was going to get the job was probably slim, because I think she would have had a lot of problems getting through the Senate. I think Powell was no problem. I mean, I think listeners need to kind of, the analogy, Dale, that I like is, think of, I'm sitting here in my house on an island in Florida, and hurricanes hit, right? Oh, this is my new one. Hurricanes hit. So what happens? The hurricane hits, prices rise, the price of roofers and everything else rises.
Yeah, right.
Takes about 6 months for those prices to readjust. The question in a year's time is what's going to happen? And the answer is, as long as there's not another hurricane, prices go back to normal. So that's what's true of the US economy. These big hikes are there now. The question is, will they be repeated next year? And I think Powell and Yellen are right. They've perhaps gone on longer than we would have thought. But my expectation is that, as is many forecasters, that these big numbers will drop out. And by the end of 2022, we'll be back to 2. That's kind of what I have in my head.
Okay, so there's a possibility that central banks across the globe are making a policy, or, well, I mean, it is, you mentioned it, COVID still happening. The economy, last time you and I talked, you came
Right.
up with a number that California was in the same position they were before '08. Are your numbers still showing slowing down of people's happiness and
Yeah.
spending and economic
Right.
weakness?
Let's talk about that, Dale. So
Okay.
the big thing that I've been doing, you showed some of the pictures on my webpage. A great deal of the work I've been doing is about well-being. So if you look at those papers, so there's a whole series of papers about the pulse of nations. Can you predict downturns? Can you predict unemployment? What's causing the recession? So the answer is in that work, and I've got a column, you see recession is the threat, not inflation. So what we do in that work is we try and think about what people say and how they feel. And that seems to be crucial. If people think the stock market is going to fall, the stock market will fall. If people think the economy is going to slow and they stop going to shops and they stop spending, then the economy will slow. The big deal in the data, which people have to understand, is that the data that predicts all 6 of the last 6 recessions, which is basically consumer expectations, particularly from the Conference Board and from the University of Michigan, those now are at the positions that they were in 2007, predicting recession. And those data predict 6 of the last 6 recessions. Now, obviously, there are other things going on which don't predict it. So normally you'd see collapsing employment and rising unemployment, and you don't see that. So obviously the question is, what does this show you? But I think the answer is all these people who keep saying the Fed should be tightening and so on, these data are completely contrary to that. Michigan survey fell again.
Right.
So these data point to carefulness and slowing. And I think the other thing, which when I listened, particularly the bank presidents, who I think are just off the planet. Essentially what you've got to understand is the virus is spreading. And the question is, what about long run changes in behavior? Are we just going to be back to normal? And are the bottlenecks going to be helped by a central bank tightening? How does a central bank tightening help ships come into into Los Angeles, into the docks? So I think the answer is, what we should be doing probably is keep the stimulus going, wait and watch, don't prognosticate, don't say we know what's coming, say here's a series of scenarios that's coming. And I think the great risks, again, are to the downside, that the central bank will make an error. And since from 2015 to 18, I opposed every rate rise the Fed did. That was clearly an error. And now the Fed admits that it was a mistake. So look at the Bank of England's decision. I think the only question at the Bank of England is when they will have an emergency meeting to reverse that rate rise. I think that's likely.
Maybe by spring.
Well, I think it might even come within the next month as they shut down further. I think any day now the government's going to shut down and go down into lockdown. And I think that the likelihood is that rate rise will have to be reversed. And the question is whether the governor of the Bank of England can survive.
How about Paul, even though he was renominated?
Well, Powell has taken a rather more sanguine approach and obviously been scared a bit by the inflation perhaps being slightly higher than expected.
Yeah, he had to eat crow by saying
he had to eat a bit of crow.
With transitory, right?
Right, but the issue is it's still potentially possible and plausible that inflation is transitory. I remember, can I remind you, I remember in July 2008, inflation was rising and the same arguments were going on. And what people hadn't understood, and we're talking about $200 a barrel oil, and the fact that the inflation was going to rise forever, realizing that nobody had actually spotted, well, few of us had, but in August 2008, inflation had spiked. And the US had gone into recession in December 07, and the whole of the rest of the world went in April. And the focus was on inflation when it was clear that was the wrong focus. Looking back, inflation was, obviously inflation hurts people, but there's a lot more work done showing you that. Let's just say, so people get it, that a 1 percentage point rise in inflation hurts people, but a 1 percentage point rise in unemployment hurts people at least 5 times more. So if you want to deal with inflation, which hurts people, by imposing something that hurts people much more, then you need to take that into consideration. And politically, that's going to be a big deal. And the issue is the man or woman on the main street is going to be impacted by rate rises, Whereas the banks may like it, markets may like it, but the issue is, what do the voters think?
Okay. And well, this may create a scenario next year. Should we break down in crude and
Right.
trade down here back at $50 or something like that, would take a lot of the inflation pressure off.
Well, I mean, I do still think, I've been saying this, and I think I said to you last time, but I've been saying it a lot, that obviously there's an issue with inflation in the sense that, yes, there are these bottlenecks, and yes, the price of goods have risen, but most consumers have an option that they don't have with the unemployment rate, because the unemployed are hurt by being unemployed, and rising unemployment rate scares everybody else. If the price of goods rises, here's a set of options that you have. The first option is you decide not to buy stuff. The second option is that you opt away from the things whose prices have risen. So if the price of beef rises, you go buy pork, or you buy chicken, or you buy seafood, right? So that obviously there's a way of that the price of them will come down as demand for things falls. So inflation tends to, you can, many of these goods you can avoid. Obviously milk and bread and oil and so on that are not terribly substitutable. But in principle, think of the price of timber. People can actually choose to not buy stuff. They just choose to spend less. I'm not going to buy a new set of windows for my house. I'm not going to buy a new second-hand car because the prices have gone up 25%. I'm going to stick with the old clunker. As soon as that happens, what's going to happen to prices? Prices are going to fall. So I think people don't really get that if prices rise, say from 100 to 106 from year 0 to year 1, and they remain at 106 for the next 3 years, prices are 6% higher than they were at the beginning, but inflation is 0. So I think the expectation is that Powell has moved away from the word transitory, but everything suggests to me that that's what we're going to see, that within 12 months, these big numbers are going to drop out and be replaced by smaller numbers. If not, why not? Tell me why the hurricane is going to come again.
Okay. I want to switch gears a little bit, and maybe you could help me with the mystery of how the U.S. went from massive unemployment and spent trillions to support those people, how we went from having massive unemployment to a labor shortage. Well, I'm a labor economist, Dale. Yeah. Right.
The way to think of this is that there are bottlenecks here. A good starting point, when you say a labor shortage, well, let's try a set of numbers which will actually get people going. The first thing is, well, how do we define a labor shortage? Well, the question is, are we really at full employment? Beveridge defined full employment to be some number, probably with an unemployment rate of around 2%. And he defines full employment to be where workers are continuously getting new job offers, and the unemployed are getting job offers that they can go to. So the question is, are we really in a period of labor shortage? Well, in some senses we are, partly because people don't want to be teachers. They don't want to go work in a place where they might get the virus. So a crucial thing to have in your head is actually what's happened to the employment to population rate. And that's a really big deal, because and I'm just going to pull up the numbers while we're talking. Let me just find the numbers and we can share the screen. Hold on. So basically the issue, let me find the numbers. I think that would be a pretty good thing for me to do. Let me find these numbers for Dale, and I'll share my screen. And I think this is really the number that people really need to look at. So let me show you this.
Okay,
if you let me share my screen in a second.
Go ahead.
Let me just give you this number. Let's go to 2000. I'll go to 1999. Go. Okay. Can I share this screen, Dale?
Yes, it's a green box.
Okay, let me go. So here's the screen that I want people to see. Can you see that?
Yes.
Okay. So here's the. You say this is a labor shortage. Okay, so let's look here. This is a very simple measure. And the reason we want this measure is the unemployment rate is a mess. So the unemployment rate is the number of unemployed over employment plus unemployment. But the problem is that people can go to another labor market status. It's called out of the labor force. So that's a problem. So this is a very nice, simple measure that I like to use. It's just what proportion of the adult population is employed. So 60 people out of 100 are employed. This is called EPOP. That's 60 over 100. So here's your question. How is this anything like labor shortage? So here we go. So this is 59.2, which is the number we've had today, and it jumped. it jumped in the last month. So people go, oh, it's a labor. Well, okay, let's go to 2020, January. It was 61.1. So we're now down 32 full percentage points. EPOP is down 2 percentage points. So what's happened is that people are not being reflected in U. They've gone to O. They've gone out of the labor force. But let's look back. Let's look back to the start of the Great Recession. So here we are in 2007, December, the number was 62.7. But let's go back. Let's go to 2000. So we were at 64.6. What's crucial here, Dale, is that if you look at a country like the United Kingdom, in many respects similar, unemployment similar, system similar, same financial services sectors and so on. In the UK, EPOP in 2021 November is about the same as it was in 2000. It's about the same as it was in 2000. So the reality is that the US, and we don't, for anybody who says there's a labor shortage, they have to tell me where the 9 million workers have gone. So if you had a 64.6% EPOP today, that's about another 9 million people who'd be working. So how is that full employment? So I'll stop sharing.
Okay.
So the question is, how is that full employment? We're down many, many millions compared to other countries. So the question is, what's preventing people getting back to work? The answer is fear of the virus is the big deal. Lack of demand in the economy, the relative attractiveness of workers and work is a really big deal. So for anybody who says we're anywhere close to full employment, you want to look at those numbers. And I've done lots of work showing that, in fact, prior to 2008, the unemployment rate impacted wages. Since 2008, the unemployment rate is a hopeless measure of what's going on in the labor market. So the first thing is you shouldn't focus on the unemployment rate. You should focus on, well, this is a pretty darn good number. So this says labor demand is well below what it was. The Fed is nowhere near maximizing employment. So I would have said, if you asked me, what should the Fed's mandate be? Well, let's get the EPOP back to where it was in 2000. That's 9 million more people in work. That doesn't suggest you should tighten. If you tighten, what are you going to do? You take the taper off, you raise rates, that number, that presumably is going to go down below 59 to numbers that we've never seen before. And the question is, what are those people doing? And the answer is, well, they take jobs. Think about if job offers came. So they get offered $10 an hour, $20 an hour, $30. Would they come to work? And the answer is that they would. So I think this is a misunderstanding of the nature of the labor market. People are not in the right places to where the jobs are. People don't want to do the jobs at the going prices. They can't afford childcare. You take off this child tax credit, people will just stop going to work because they can't afford to do it. So this is about a labor market in trouble with sets of bottlenecks and people just being scared of going to work. But anybody
PTSD, people after a few years of this, and there've been so many and I noticed that you talk about psychiatry, social psychiatry. I mean, there's never been more of a need for social psychiatry with the emotional roller coaster we've all been on for 2 years.
So we've been looking at, so in the US, we have this problem we call deaths of despair. Now that's about nearly 100,000 people a year dying from drug overdoses, which pales against the numbers that have died from COVID. But the evidence is, well, a few bits of evidence, particularly since the onset of COVID, what we've seen is that it disproportionately has fallen amongst the young. So 20 to 29-year-olds are the ones who've had COVID the most. But their mental well-being has really deteriorated a lot. So in the United States, so that's a really big deal since 2020. And if we look at mental health in America and distress and inability to kind of do the things that your father did, that's a major set of social questions. So distress in America, and I've used the word distress in several things that I've written about. Distress in America has risen dramatically, and I think I've shown you this before. The proportion of people who say every day of their life is a bad mental health day has doubled over the last decade or so. So I think that this is an issue, and if people keep saying people just should go back to work, everything's absolutely fine. Well, it's not absolutely fine, and if you, in a sense, if you were anywhere close to labor shortage, if you were anywhere close to full employment, people would feel a lot better than they do. We would not be seeing collapsing consumer confidence. We would not see these levels of poor mental health. So I think it's about central bankers who don't walk them. They walk the streets of New York and London and Chicago and San Francisco. They don't walk.
They need to go to Des Moines, Iowa.
Des Moines, Iowa, exactly. So I think there's this, in a sense, the position that I take is that, you know, the person walking. I call it in England. I call it I've talked about the man or woman on the Milan Road Omnibus. The Milan Road there is an interesting place. It's the road out of London. It dates from about 1100. But why it's called the Milan Road is it's a mile from Aldgate. So it's a mile from the City of London. So there's the City of London and what happens in the City of London. And then a mile away, there's this road that people have walked on for 1,000 years. And the answer is there appears to be a growing disconnect. And that's what we've seen around the world. And the idea that you're now going to tighten in a world where EPOP is at 59, not at 65, seems a major issue. And that's sort of what Powell and Yellen have talked about. Yellen especially, because Yellen's a labor economist like me, and she's aware of these things. And Janet and I think in many ways have been extremely close. I know her and I've spoken to her many times, but I think she and I express a similar view, which you can't discount. You cannot discount this view that the labor market is in trouble and that many of these things will be transitory. And if you were to raise rates, it will potentially be.
What may not be transitory is the results of years of psychological distress.
Well, that's right, Dale.
I mean, even on a personal level, if you go to, take an interest in trying to get better, whatever the issue is, there's a time period of work and healing. And
absolutely right.
It's not going to happen overnight for everyone to just say, "Hey, everything's okay again."
Well, I think that's right, and there's a great literature. People can read the book by Angus Deaton and Anne Case, where they talk about deaths of despair. So there's not only despair, Dale, but we've seen this enormous rise in drug overdoses, but also in suicide, also in cirrhosis of the liver. So we're seeing morbidity and mortality being impacted. And in a sense, what I hear in people in the markets is they sort of think that that's irrelevant. We care about interest rates and we care about the rate, but what about real people who are struggling through this thing with every expectation that Omicron is going to be worse? We're looking, as I said this morning, Quebec shuts down, the Netherlands shuts down, the UK is likely to.
They're talking about 1 million cases a day here in the US.
Absolutely. Absolutely. And so in a sense, this is not simple, but how does a central bank tightening help you? I mean, okay, I understand that inflation is rising, but all the research that I've seen and participated in suggests that tightening, so it's not that, people say, doesn't inflation hurt you? Well, sure it does. But the question is, what's the alternative? And all the alternatives look worse. So I think, say again, 1 percentage point rise in inflation compared to a 1 percentage point rise in joblessness, well, in various measures, but the answer is between 5 and 10 times worse. So it's not like, we solve inflation and then everything's great. You do what the central bankers and the commentators all say you should do, and that makes it worse. Well, someone's just suggested not tapering causes asset bubbles.
Yeah.
Well, then if it's an asset bubble, let's think about that. It's a good comment. The question is, as a central banker, what is your job to burst asset bubbles? Well, the first thing is that an asset bubble, for people who are if people inside an asset bubble don't think it's a bubble because they wouldn't be in it. The second thing is, can a central bank deflate that bubble, simply
without collateral, without
the collateral damage? And in a sense, if you're in an asset bubble and the bubble bursts, well, that's your fault. It shouldn't have been in the bubble in the first place. Not sure as a policymaker.
Well, everything's a bubble.
It's not my fault.
We're in the everything bubble now, Dan.
Yeah. Well, we're in the everything bubble. You're right, Dale. But in a sense, what can central bankers do? Clearly, what QE did, and I voted precisely to do this. We vote for QE to basically, raise asset prices, allow people to take more risk, and try and put the economy back. You can't cut interest rates more, but that's had side effects. And I think the reality is that all of this stuff lies at the door of the fiscal authorities. For example, there's nothing the central bank really can do after it's done QE that it can do to help inequality. But that's the job of the fiscal authorities. If they choose not to, that's up to them. right? And
Right.
so if you, essentially the world of the central bank has created these bubbles because it's the only things it's got are asset purchases and interest rate changes. The fiscal authorities have just backed off and said, let the central bank do it. And then there are consequences. But the fact that there are asset bubbles, I mean, to be harsh, well, then you made a bad decision, you're going to lose. Tough.
You know what, Danny? A great conversation and a great message in the season we're in. And maybe now that people could put some numbers to the distress their
Yes.
neighbor or their
Well,
community
right. Care about
might
the
be
well-being.
in.
Right. Care,
Yeah,
the
how
message is-
about, here's my prescription, and it's
Yeah.
not about tightening, it's not about QE. How about having a glut of kindness?
Absolutely.
All right.
Absolutely.
And you know, it was kind of you to just come in here, Danny, during the holiday season and share with us. I hear the passion in your voice and
Can I just,
concern.
can I say something quick? If
Go.
you go back to, I've gone back to read Alan Smith. If you go back to read Wealth of Nations, the book before it was actually about the theory of moral sentiment. And I would encourage people to go and read the first 2 paragraphs, which is almost exactly what Dale said. Smith talks about kindness and compassion of other people being a central part of the human condition. And that he wrote before the Wealth of Nations. So Dale, the theory of moral sentiment is almost exactly what you just said. Go back and read it. It's about caring about the well-being of others, and that improvement.
He also wrote about that debt is enslavement. Either do it with the military or debt. Maybe we need to be thinking about a jubilee. It happened throughout history. Maybe we, instead of trying to inflate our way out, we come up with a plan and just forgive people's debt.
A plan, Dale, is better than Guessonomics.
Yes. Danny, Merry Christmas, my friend.
You too. You too, buddy.
Happy New Year. Yeah, we'll get back together after New Year's.
Yes, sir.
All right. Danny Blanchflower, everybody. I hope you enjoyed it. I learned from Danny every time I talk to him. That's a wrap for us here. It's also the first day of winter. Let's have a great winter despite the weather outside. And you know what I mean by weather, you know, the virus storm that we're in. And you could join the crew in 13 minutes for the morning edge. Thank you, everybody. Adios. Thank you, Danny Blanchflower.